Hi, everybody. This is Mrs. Webb, and we are going to get started talking about Chapter 9, which is all about get this off here, which is all about merchandise and corporations. So, this is a new topic for most of you. In the first semester, you spent the majority of your time going over and learning about a sole proprietorship. In this chapter, we start corporations, and part of that is starting with merchandise, something that we didn't have to deal with before. So, we're going to go through the difference between what a retail merchandising business is and a wholesale. We're going to identify some of the differences between that sole proprietorship and corporation. And then, what is a subsidiary ledger? Yes, that is a very hard word for some people, but it is subsidiary. That's how it is pronounced. So let's get started right off the bat with talking about a merchandising corporation. So, a merchandising business that is set up in a corporate structure. So, to think about a merchandising business, everybody knows who Walmart is. Walmart is considered a merchandising business, a retail merchandising business, because they sell directly to consumers. So, when you and I go through Walmart, we are the end consumer, and so that is what makes Walmart special. So we are going to be the ones that are going to be consuming those goods. Now, I'm sure all of you know what a wholesale merchandising business is. It's super duper popular. It starts with a C, and that is Costco. Now, Costco is a little bit different in terms of wholesale because they do both. They do both wholesale and retail. So, now here's the difference. Retail, like I said, is selling to the end consumer. So, when I go into Costco, because they sell everything in bulk. So, when I go into Costco and buy my $70 50-pound bag of dog food for my Great Dane, and I buy toilet paper and paper towels and all of those things that I buy every month, that part of their business is the retail merchandising business. Now, I also run our Business Professionals of America club on our high school campus, and we sell candy during the day. I am not the end consumer of that candy. Our students are. They're the end consumer. So when I go to Costco and I buy and I'm the end consumer, I pay something that a wholesaler wouldn't pay. And that is taxes. So when you sell things wholesale, that means that when you are buying, you are not the end consumer. You are selling it again to the end consumer. So I buy candy and then I sell it to my students for a little bit of a profit, and then they pay the tax on that candy. So it's added in as part of the cost. Okay, so retail sells directly to the end consumer. A wholesale is kind of an intermediary. They're the ones they buy to sell to the direct consumer. And a lot of businesses do that. Now, they're going to be set up as a corporation. Now, big difference between sole proprietorship and corporation. Sole proprietorship is a one owner business. You are the CFO, the CEO, you are it. You are the one and only, and your business is tied directly to you. So if somebody, slips and falls in your business and they break their hip, who are they going to sue? They're going to sue you. And that means that you have the potential, since that business is you have the potential to lose your house, your car, everything that personally belongs to you, and including the business. Corporations have a separate structure. Corporations start at the top with the board of directors. Underneath it is the CEO. And if you don't know what that means Chief Executive Officer. Under them are the others, what I call the COOs, the COO, the CFO, the CMO, the CTO. So those are like the chief executive or the chief operating officer, the chief financial officer, the chief marketing officer, the chief technology officer. Those are all the COOs. And then underneath them are your middle management. And then of course at the very, very bottom, you have your everyday workers. So that's the form of the corporation. Now, everybody asks, well, who's in charge? Well, the CEO runs the business, but they answer to somebody. They answer to that board of directors, and that board of directors makes sure that that CEO is doing what they can in order to make money. Because even though it's not written in the setup of the corporation, the board of directors do answer to somebody, and that is the stakeholders. Those are the people, and the stockholders. Those are the people that buy stock in the company for the purpose of making money. So those board of directors do answer to their stockholders. So it's in their best interest, if they want to continue to work on the board and be on the board, it's in their best interest to make sure that they are keeping that CEO in line. Now, just like every other business, just like anything that we have to do in accounting, we still have the accounting equation. It does not change. Well, it changes a little bit, but the base doesn't change. Assets equals liabilities plus owner's equity. Now, instead of what we're going to be doing, instead of owner's equity, it's now going to be stockholders' equity because our stockholders are our owners. So that's one of the biggest changes to our accounting equation. And since our main stockholders' equity or owner's equity account is capital, we are going, that means that we're going to have an account called capital stock. So our stockholders, in order to be owners of our business, are going to buy a share of stock. That stock symbolizes the ownership of that business. So even if you were to buy one share of Microsoft, you could say that you own a piece of Microsoft, and it would be true because every single stock represents ownership. So our main capital account now, instead of being the owner, comma, capital, it's now going to be capital stock, because if the corporations need to raise money, they're going to sell stock. So, perfect example. I don't know if any of you guys have seen the commercials, but they're putting out, Carnival Cruise is putting out a brand new, big, huge cruise ship. Now, those cruise ships cost anywhere from 500 million to $1 billion. That is a lot of money. And these corporations, they don't have that kind of cash right on hand. So they sell stock in the company, and they sell bonds, which are similar to loans. They sell stocks and bonds in order to raise the money in order to build those huge, big cruise ships. So same thing with any corporation. If they're growing, right? They need to expand. They're going to need money. And capital stock and bonds are a great way to make that money. So, it's a little expensive in order to create a corporation. So, unlike everyday America, where if you're going to be a sole proprietor, you could fill out some paperwork, take it down to City Hall, pay a little bit of fee, and now that business is you. Unfortunately, with a corporation, it becomes a little bit more complex. So you have to create something called the Articles of Incorporation. You typically do this because it's a legal document. You typically hire a lawyer to do this, which means automatically the amount that you're going to pay in order to form this corporation is going to go is going to go up. And then once you file and create your articles of incorporation, you're going to have to create a charter that, like it says, is state approved for you to conduct a business. So both of those things require legal help, and that means that instead of costing you a couple $100 to start a business, it might cost you a couple tens of thousands of dollars, 20, 30, 40, $50,000, depending on the size of the corporation you want to build. Now, here we go. One of the big differences between last semester and this semester are our customers and our vendors. So our accounts receivable, which are our customers, and our vendors, which are our accounts payable. Now, they were tied to the individual accounts. So it'd be like accounts receivable dash John Doe, right? Or it'd be accounts receivable dash Office Depot. Okay. Now, in a corporation, there are way more accounts than there are as a sole proprietor. And we're growing, we're bigger. That means that we could have 100 or 1,000 or 10,000 customers, and the same for vendors. So I know we've talked about the general ledger, and the general ledger is a book, right? It has our assets first, liabilities, owner's equity, our revenue, and our expense. And the numbers are 100s, 200s, 300s, 400s, 500s tell us where we're at in that book. If we were to add all of our customers and all of our vendors, that book would go for would be 10, 20 feet long. If we tied every single account, if we had accounts receivable dash a customer, if we had all of our customers individually listed, tied to our accounts receivable or accounts payable accounts. So, in order to not do that to our general ledger, just to keep it our base accounts, our accounts payable and receivable become what we call controlling accounts. And I like to describe it as accounts payable and a receivable are like the parents, right? They're the parents, and all of our customers are the kids, and all of our vendors are the kids. So we have a book, a subsidiary ledger, just for all of our customers, and we have a book, a subsidiary ledger, just for all of our vendors. So then that means instead of just one book that would be extraordinarily huge, we have 3 smaller books. So we have our general ledger, and then we have our subsidiary accounts receivable ledger, and our subsidiary accounts payable ledger. So remember, think of now our accounts receivable in our general ledger as the parent, and all of the kids go in the subsidiary ledger. So all of the customers and the vendors. So this is kind of an example of what it would look like. Obviously, the general ledger is the green book, and the accounts, you see the accounts payable ledger with all of the vendors and how much money they owe, or we owe them, right? Because it's payable. So all the accounts that we owe, and it has a total. And notice the total on that tape matches the total that's in accounts payable in the general ledger. And that is how it should be. So we always know our individual vendors always get updated first, right? Because when we post weekly. And then at the end of the month, our accounts payable accounts will be updated. Okay. So on the bottom in the green is what we see in our general ledger. Okay. It has our date, item, post reference, debit and credit. Notice it's the same on the yellow. The yellow is our subsidiary form. But notice the balance, and this is where it's a huge difference. So at some points when we pay, we might end up with a negative accounts payable balance depending on when we pay, when we buy, right? The only thing is in our vendor, and I want you to look at the numbers too because they're important, the vendor numbers and the account number. But in the balance, notice it says credit balance, and that's because those vendors and our customers should never have a negative balance. So, because these are payables, right? That means they're liabilities. That means they start with the number 2. So, you see accounts payable is a 2000 number now because we have more accounts. And notice the vendor is a 200 number now. All right. Now, merchandise. Merchandise is super important in terms of a company like Walmart. Their merchandise, that's what they sell. When we go into Walmart, we're not typically buying a service, I guess, unless you get your hair cut or get your tires put on or, oil change, but you're still buying a product, right? You're still buying the tires, you're still buying the oil, all of those things. They are a merchandise business. So that means that when you go into Walmart, you're buying something and you're walking out with something. So merchandise, when you go into Walmart, there's a couple of different kinds of inventory methods that we're going to talk about. And that means that those are methods that how Walmart keeps track of their inventory. That's all it means. How Walmart keeps track of their inventory. So when you walk into Walmart and you buy something, what do you do to the item? If you said scan it, yes. When you go check out, the one thing that happens is you scan that item. You scan the item on the cash register and then you pay for it and then you leave. That, by scanning that item, Walmart knows that that item now has been solved, that has been sold. So when they bring the item off the truck, they scan those items into the inventory so it shows up into the store. They stock them, and then we scan them again on the way out. That is what's called perpetual inventory. So Walmart knows when they walk around with their little hand tools, they know exactly how many pieces of inventory of that product that they should have on the shelf, right? Should. Now, I always ask, is perpetual inventory going to give you an exact amount of inventory on the shelf? I hope you said no. Now, this is the reason why. There's something called a 5-finger discount, and that means that people are stealing stuff. So when I buy stuff, I scan it through the cash register when I leave. When somebody steals something from the store, right? It doesn't get you don't have a person that scans it and then walks out and doesn't pay. Sometimes you do, but mostly they just don't scan it at all. So, even though it is a great tool to give us an idea of how much inventory we have on hand, it doesn't tell us exactly. It doesn't give us the absolute end all number. So, that's perpetual inventory. The next type of method is the periodic inventory. So, at the end of every year, I don't know if you've noticed in your local either I'm sure I was going to say Kmart. I used to work for Kmart, did for 8 years. But when you walk into your local Walmart, once a year, you see all these tags from a company called Regis. Now, this company is an inventory company. What they do is Walmart hires them. They go in. I mean, we used to use them for Kmart. You hire them, they go in. They physically count every single item in the store. They have what it should be, and then they physically count it. And that is the periodic inventory, because they only do it like once a year because it's such a huge job. So, perpetual inventory is an ongoing account of the inventory through scanning it in and scanning it out. Periodic inventory is that kind of once a year inventory that they have a third party company do it. Now, one of my students always asks me every year, why doesn't Walmart do it? Well, here's the deal. Walmart does do it, but one of the biggest, one of, I would say, some of the biggest thieves are not necessarily people outside the company, which means that a lot of there's a lot of internal theft. And so it's just, that's it just happens. We had a lot of, we had internal theft at Kmart. There's internal theft at Walmart. It just happens. So they don't trust that there's not going to be something that happens. So that's why they bring in that third party to come in and do that inventory count to make sure that it's accurate. Now, we had the five fingers, right? Assets were 1, liabilities were 2, owner's equity were 3, revenue was 4, and expenses were 5. Now we have to add, because we have merchandise, now we're going to add an extra finger, and we're going to slip it into the number 5 rule. So after revenue, but before expenses. And that is what we call our cost of merchandise. So because we have to purchase merchandise, right? I'm going to use my cash to buy merchandise. What type of account would we consider merchandise? Asset, liability, or owner's equity? Hopefully you said asset, because if I'm using my cash, I own it. So we're adding those costs of we're adding some accounts in that cost of merchandise section, which we're going to add into our 5s. So just like before, we're with our source documents, we had S's for sales, right? We had R's for receipts. We had T's for tape, for our register tape. We had M for memo, and we had C for checks. Well, we are going to be buying merchandise, and we already talked about merchandise. When we buy something or sell something, we do it through an invoice. Well, we call those invoices when we purchase merchandise. Now remember, this is merchandise we're going to resell, not use, right? Supplies, we buy and use. Merchandise, we resell. So that's a huge difference. So just keep that in mind. So this is an example of a purchase order. So for this semester, we are going to be 3 green products. We are purchasing from Win Lighting. We are on the bottom, it tells us how many in the quantity, the description, the unit price, the total. There's a PO number, which is purchase order number. This one's 153, and the date. And I want you to notice that right here is our purchase order number and the date. But down here, notice there's something missing. When I buy stuff, right? When I buy stuff as that end consumer, what do I have to pay? Hopefully, you guys were like, oh, yeah, sales tax. Well, remember, I'm buying merchandise to resell. So I am not the end consumer. My customer is. So notice there's no sales tax added here. And that is because it will be resold and the end consumer is going to pay the sales tax. So we have been using the general journal. Now, every single transaction involved at least 2 accounts, right? And when we posted, you had to post each of those accounts. And I said at least 2. Well, here's the deal. We have so many more accounts and so many more customers and so many more vendors that if we used the general journal, we would be posting like crazy. It would be posting, posting, posting. And we all know that posting is your favorite thing to do. So what they did was they came up with 4, I know it says 5, they came up with 4 special journals. So they came up with a purchases journal just for purchasing merchandise on account. So whenever you see the P at the end of the transaction, that means it's going to go into the purchases journal, the P journal, right? Purchases journal. You see the P. Then they did the sales journal. Now these are only sales on account. So that's when you see the S at the end. Okay, the S source document, the sales document. So that is all of those are going to go into the sales journal. So remember, purchases is vendors, sales is customers. And then we have so many transactions that deal with cash. They decided to split it up. So now we have a cash payments journal. And that source document, whenever we pay cash, is what? Hopefully you said a C because it represents the check. So cash, whenever you see the C, that means that it's going to go into the cash payments journal. And then we have our cash receipts journal. So that means that we're receiving cash. So the R's and the T's. So we're still dealing with the same source documents. They're just going to go into different journals. We still have the general journal. It's still our friend. It's still our best friend. Our general journal just is there now to pick up any other transaction, like the M's, that don't belong in any of the other journals. So it is still our best journal. The reason why they do the special journals is to limit the amount of posting. They don't want you to have to post and post and post. All right. So let's talk about the purchases journal. Here's what it looks like. So notice up here in this top corner, there's still a spot for a page number. So this is the purchases journal. Remember when we just had the general journal, it was G and the page number. Well, this is the purchases journal. So guess what it's going to be? P and the page number. So it has our date. It has our spot for where we put our vendors. It has a spot for our purchase numbers. It has our post reference. So when we update those individual accounts, and then notice this one column. I want you to really look at this. It has 2 accounts in it. Now, the reason why they did this is because this amount is going to be the same. So why would we write the same number twice? And that's why these special journals were created. So we could fill out this because we would owe $500, right? That's our accounts payable portion. And notice CR is credit record or credit, right? And purchases, the purchases account, which is going to be new, it's one of those cost of merchandise accounts, is our debit record or our debit. So because it's the same number, we could put it all in on one line. We don't have to have 2 lines for it. So we would have like the date, Office Depot, the purchase order of number 100, and then just one number here. So that's why they do the debit that's why they do the purchase journal like that. Now, when we look at the purchase invoice, there's one thing that they always ask us to do is look for the stamp. The stamp is when we receive the invoice. Okay? So We look for who received it. That's the initials. We look for the date. And we look for the document number that we have assigned. So this is the information. So this is the invoice from Win Lighting. Remember, this is our bill, right, from them. We are this number to them, but they are this number to us. So the stamp is us, the rest is them. And so the stamp and the check mark show that they have double checked to make sure that 200 times 305 is 610, 150 times 315 is 472.50, and that's our total. So we're going to take that information and we're going to journalize it. So here's what that transaction looks like. So November 6th, we purchased merchandise on account, and that's super important, from Win Lighting. $1,082.50. Purchase invoice number 55. So this is what it's going to look like in that purchases journal. So here's my date. Here's who I bought from. Here's my purchase invoice number, or P. And then here's my amount. Okay. So just a reminder, we post individual things in the journal, general journal, or in any of these journals. So individuals like Win, we would update those accounts weekly. Okay. Now, when it comes to, so here's an example of us posting weekly. This one they posted, right within the week. You see it says purchases P11. This is a payable credit, right? And then we're going to, since this is a credit balance, a credit plus a credit and a credit should be a plus, right? When they're the same, we add. When they're opposite, we subtract. And then we have our ending balance. So Win Lighting, we know exactly how much we owe them. So individual numbers get posted at the end of each week. Our total, so all of these post references would be filled, right? And then at the end of the month, we're going to post to these two accounts our total. So of course we single roll, we have to date it, we put our total, we single roll, we add all of them together, we double underline. Remember that double underline, that single roll means the next number is going to be a total. The double underline says that that number is accurate. And then we post that number into those two accounts. So instead of posting, the 9 transactions or 8 transactions to purchases separately, we can just post one number. Boom, here it is. Here's the total. I've posted it one time at the end of the month. And then notice that my posting is in there. My posting is right underneath. That 5110 is under there in brackets. That shows that that account has been updated. Same thing with the accounts payable. It shows that that account, that 2110, that count has been updated also as the credit. So the purchases went in as the debit. The accounts payable went in as the credit. So we only have to post to those two accounts once instead of multiple times. It saves us. Cash payments. All right. Are you ready for this? Oh my goodness. If you look at, I want you guys, don't look at line 3, 4, and 5. Act like it doesn't even exist. If you look at this part of the journal, it looks like what? It looks like the general journal. Now, here's the deal. A lot of our checks that we write to our vendors. And so that is why they added these two columns. They added an accounts payable column, which is, remember, our vendor, and they added a purchase discount column, which goes with our vendor. So our vendor may end up giving a discount for paying early. All right, and we're going to talk about that. And then, of course, we have cash. So cash, every single transaction is going to have a cash credit. because cash is going out. So this is the setup of our new cash payments journal. So discounts. Now, businesses encourage people to pay by giving them discounts. Now, there is a typical what we call 210 N30. So 2/10 N/30. Now, the 2/10 means they're going to give us a 2% discount. So the first number is the percentage of the discount. So they're going to give us a 2% discount if we pay within 10 days. So the 2 or the first number is the percentage of the discount. The second number is the number of days they have in which to pay. So 210 means 2% if we pay within 10 days. So if we owed $1,000 and we paid it within that 10 days, we would literally only pay them $980. We still owed them $1,000, but we'd only have to pay them $980. So $1,000 is what we owed. Our discount would be the $20, and then we would pay them $980. That's how much would come out in cash. So, and then N30 means N means net. So that means the whole. So it's either 2/10 or N/30. So if we don't pay it within the 10 days, let's say we don't have the money, then we have to pay the net, which is the whole thing, within 30 days. The 30 is the number of days. So N means whole, and then we'd pay the whole amount within 30 days. So this is what a transaction looks like, just writing a check. We write checks for this all the time. November 3rd, this transaction, you guys have seen 100, probably even 1,000 times so far. On November 3rd, we wrote a check to Kessler Promotions for advertising. $600, check number 689. So remember, what are we writing it for? We're writing it for advertising. So that account should be advertising expense. Okay. Our expenses are going up, our cash is going down, and when we record it into our cash payments journal, we have our date. We only need to write the advertising expense. We put on our check number. Our cash is going to be our credit. That means that advertising expense is going to be our general debit. So we have accounts payable. They're not a vendor. It's just an expense. So it doesn't go into either one of these special columns. It's just going to go into the general column. So we have our general debit and our cash credit. Okay. The next one is writing a check for supplies. Now, I love this. It says for store supplies. Totally Cengage mistake. This should say supplies store then instead of supplies office. So they made a mistake. But, it happens. So this is just buying supplies with cash. So we write the date. Here's our supplies store. Check number 690, 5620 in our general debit, and our cash credit is 5620. Now, we are buying merchandise to resell with cash. Now, this is different than the purchase, right? We're still purchasing merchandise, but when we have a P, that means we're paying for it, right? When it has the P for the source document, that means that we're buying it on account. So we're paying for it at a later date. This transaction is we're purchasing that merchandise right now for cash. So we have November 9th, we purchased merchandise from Polar Refrigeration for cash, $480. Check number 697. Now, we're going to use that purchases account, right? Because we're still purchasing that merchandise to resell. So we have the date of the 9th. We have purchases, check number 697. We have a general debit of $480 because it's not a vendor. and we have our cash credit of $480. All right. So this is how we are going to figure out purchases. So purchases, that is the normal account. That is our parent account. So we have something now that we have inventory. We have purchase discount, right? So we might not have to pay the full amount. And then we have another account called purchase returns and allowance that we're going to talk about in, believe it's in chapter 11. So purchases is our parent account, our controlling account, and then purchase discount is a subsidiary of purchases. So this is an example of us getting a discount. So it said on November 14th, we paid cash on account to Galley Electric, $627.20. So that's how much cash we paid. Now it gives us some detail. Now it says covering purchase invoice number 489 for $640. So this is how much the original invoice was for, $640. Then it says less 2% discount. Well, they were nice and they figured it out for us. So they said it's $12.80 and it was check number 702. So this is what it's going to look like when we put it in the journal. Now let's go over why we put the original amount here. Let me just fill in all those boxes. So we have the date, we have Galley Electric, we have our check number. Now we have to put the full 640 here in our accounts payable. The reason why is if we only put the 627.20 here, when we updated that account in Galley Electric, it would still say that we owed them the $12.80 that they gave to us as a discount. So we have to put in the full amount here because once we pay them, the account is going to be cleared. It's going to be zero or whatever it is back to null of this 640. Then we are going to record the discount that we were given, that $12.80. And then here we're going to write that 627.20. Now, when you take your two credits, notice this says debit, this says credit, and this says credit. When we take our two credits and add them together, these two numbers equal 640, which equals our debit of 640. So even though there's more than one credit, those two credits added together equals our one debit. So remember, your debit equals your credit. So here's an example of writing on account when they don't give us a discount. This one was just like, hey, pay at the end of the month. So we wrote a check on the 21st, S&R Imports, check number 706. The amount that we owed was $25.12, and that's how much we paid. So it will let us know if there's a discount or not in the transaction. Now, the last part of this is your very, very, very best friend, the petty cash fund. Remember, we're still only paying what we used. So we paid for advertising, supply store, and miscellaneous. And then we had a little cash over issue here. So here is still the same transaction that we did in the general journal, just it goes in the cash payments journal because we had to write a check. Okay, so it's still only using the accounts that we used and cash. Remember, never, never, never use petty cash unless it's to establish, and you only use it one time ever to establish. The only other time is if you're getting rid of the whole fund. So replenishing, you're only using it for the accounts for what you bought, what you use that money for. Okay, the last one, previous, I got a little click happy, is our posting. So it says a credit limit is the maximum outstanding balance allowed to a customer by a vendor. So just like any other credit card, you have a credit limit. So some vendors will put an amount on the amount that you can charge for a month or for a year or whatever, and then you have to stick with that. So just like a credit card, a very base introductory credit card usually has typically a $500 credit limit. So that's just a kind of an FYI kind of thing. Now, when we are posting, we post individuals, like I said, every single week. So at the end of each week, the individuals are updated. So this is updating Beard and Chemicals, right? This is cash payments. So we have to put CP, right? We can't just put cash because remember, now we have two cash journals. So we have a cash payments journal and a cash receipts journal. So we have to put CP and then the page number. And then we do just the accounts payable. So when we would post the generals, we do the same thing. But this one, we're just posting the accounts payable, not this. Okay, not the cash. Cash will be posted at the end of the month. And so we're just keeping track. And then once we have that account updated, we'll put that vendor number into our cash payments journal. This one is just another example of an individual, right? Posting. We have purchases, CP, right? This is a debit. And then you have your debit balance, right? Debit and debit are the same, so they're going to add. Now, you have more, I'm going to tell you right now, you'll have more debit purchases on account. So that means they're going to go in that P journal, that purchases journal. Then you will have purchases in our cash payments journal. Just an FYI. Okay, now posting. We've got to get this over with because I know you guys are tired of hearing my voice. So posting totals, the date, the word total, we single rule, we add up all of our columns. This is where your 10 key skills will come in handy. And then once you have verified that your debits equal your credits, then you can double rule. Do not double rule until you double check to make sure your debits. So I would add my general debit to my accounts payable debit, and I would get that total. And then I would add my general credit to my purchase discount credit and cash credit and get that total. And those two totals should equal. Now, at the end of the month, then I'm going to post. Now, notice these check marks underneath the general debit and credit. The reason why those are there is because those transactions, like rent expense, have already been updated individually. Okay, so anything that goes here in that general debit or credit, that's already been posted individually at the end of each week. So we put the check marks under there to show that those accounts have already been updated. Now, under accounts payable, you see the 2110, purchase discount, the 5120, and cash 1110. All of these numbers are posted at the end of the month. So accounts payable will be posted as a debit. Okay. Purchase discount will be posted that amount as a credit. And then cash is going to be posted as a credit. So once all of that is updated, then we have here our accounts payable ledger. That's that subsidiary ledger. And that's the list of all of our vendors and their ending balances, right? Their ending balances. And then from here, we create a report. So just like our worksheet, just like our income statement, we have our report. So our first 3 lines are our who, what, and when. And then we have a list of all of our vendors, how much they currently owe us at the end of the month. And then we have our single rule, our total accounts payable. we add them up. There's our number. And we can't just double underline it. We have to double check this number. And we double check that number with the general ledger for accounts payable. Now, those two numbers have to equal in order for us to double underline, okay? So we can't just double underline. We have to make sure that this number equals that general ledger number. All right, guys, that is chapter 9. That was a very long chapter, but hopefully you have now a better understanding of merchandise inventory. Have a great day.